So the next topic is optimizing ETF execution strategies and tools for the European market. For that panel, I'm joined by those three gentlemen who briefly will introduce themselves in a second. Would you like to start, Robin?
Absolutely. I'm delighted to see so many people in one of the last sessions. So well done, Deutsche Börse, and well done, Annette. So my name's Robin Mess. I'm the CEO and co-founder of XYT. We are a data analytics firm. So what we mainly do is we capture tons of data, primarily from secondary markets, that results in petabytes of data sets that we then turn into value for our clients, including sell-side firms, issuers, and investors.
Alexandre Roubaud, working for BlackRock, in charge of the secondary market team within our ETF cap market. So the aim of my team is obviously to develop access and liquidity for iShares across Europe, but we're also focusing on the surrounding ecosystems such as ETF options, ETF unit lending, and ETF as collateral.
Frank?
Yeah, my name is Frank Mohr, heading the ETF sales training team within Société Générale. Société Générale is one of the, I would say, leaders of market making for ETFs in Europe. We are covering more than 6,000 lines in Europe on ETFs, and that is our main business. And of course, we are interested in developing the system, the ecosystem, together with the issuers, together with the exchanges, and that's our task.
Thank you very much, gentlemen. I should say that Farisa Kardanova unfortunately can't join us, so she's still here on the description of the panel, but unfortunately not here. So with that, let's start off with you, Frank. What are the most used execution strategies for trading European ETFs?
I mean, when I look back, we do market making already since 20 years. I received my orders by Excel sheets and emails and whatsoever, and put it into our trading system. It has fairly developed over the time, and meanwhile, the RFQ business, the risk trade business via RFQ tools, is the state-of-the-art trading at the moment. Yeah, but we are here to also discuss new ways to execute ETFs, and that's what we hopefully achieve here.
And you on that, Robin?
I mean, ETF markets are a great success story. Success comes with changes. We've heard this morning that the adoption is growing, diversification is growing. With that, volumes are growing. We are seeing record volumes not only from a primary market perspective, but also from a secondary market perspective. There's innovation happening, new mechanisms, and that changes the way we trade or investors trade ETFs.
Alex, what are your clients' preferences when it comes to ETF execution, and how do you guide them in also choosing the right way?
That's a tough question. So I guess maybe first, to Frank's point, it's fair to say that you have several ways of trading ETF. I would personally define them as four of them: NAV trading, risk, as you mentioned, forward benchmark like MOC and so on, and then after obviously algorithmic. Now, in terms of trends, when you look at the evolution of ETF trading over the years, of course, there is a technology aspect, but there are also some fashion aspects, if I can say so. You look back to 15 years ago, people used to trade ETF like they were trading mutual funds versus NAV. It was fairly popular. Then 8-9 years ago, I would say, risk trade became very popular, I guess, for three reasons. Number one, clients were a bit more comfortable with the concept of intraday liquidity, MiFID II, and the request of basically reporting your activity, and the fact, to your point, that RFQ platform came with some very robust protocol to answer all clients' needs on that front. Now, over the last 2 years, I guess I can see two trends and growing adoptions for benchmark, especially with MOC. And I guess this can be explained by the fact that ETF are getting more and more popular in portfolio model, but also ETF are getting more and more popular in a structured product, and as such, MOC is quite a global benchmark used across the industry. But algo also is growing, and I guess this is because many dealing desks start to question the need of transferring risk immediately, and might start to see the benefit of working in order. So now we are at a stage where I guess dealing desk got a complete toolkit where they can define based on the need, their view on a product, a view on the market, on whether using an RFQ for risk or NAV, or working on orders through some ETF algos that are also evolving fairly quickly.
Frank, given the fragmented nature of the European ETF market, so what are the key considerations when choosing between on-exchange trading and RFQ platforms to achieve best execution?
Yeah, especially this fragmented market is more or less the reason why the RFQ tools were so strong. That was suddenly a tool. I mentioned at the beginning we received the orders by fax, whatever, by emails. And it was suddenly a tool where you could execute your ETFs as an institutional investor on one platform. Doesn't matter where the product was listed, whether it was listed here in Frankfurt or listed in London or in Switzerland. One platform, and suddenly as a trader you could execute all products on one system, and you put all the market makers in competition. Fine, happy days. That is also supported by MiFID. Best execution, also best execution, the rules were fulfilled with this system, and that is, as I said, the state-of-the-art trading for a long, long time. But as we mentioned, things develop, and now, we'll go in the next stage.
Robin?
Yeah, I think one of the changes that we have heard this morning and that we are observing for some time is the growth of retail flow. So retail flow means that there might be a new source of valuable liquidity. So while we could claim that in the past, when I was trading RFQ, I was actually interacting with the same market makers that I was interacting with through the lit market, today you would say, well, maybe retail flow is actually more interacting through on-exchange mechanisms. So if I want to interact with that, I should definitely consider and test new mechanisms, whether it's an algo or direct execution.
We have a question from the audience, which is, when we talk about pre-hedging, is it a non-issue, or do you think that's something the regulator needs to tackle? Anybody volunteering?
I can start. Okay. I read only the papers. I see what's in the press regarding that. Yes, everyone can make its mind about that topic. And for the ones who don't know what is pre-hedging or what is meant with pre-hedging, when you go via an RFQ tool, you as a trader of an ETF, you go out and request a price for 1 million shares in XYZ. Two-way, not one-way, two-way. And you request this from 5 market makers or even 10 market makers or even more. And you can imagine that there is a lot of information going out to the public. Not all of them will win, only one will win the trade, and the rest, 10, 15 people, know exactly that there's a large order in a particular ETF in the market. And now we can, you all have fantasy what can happen with this information.
Alexandre?
Yeah, and after I will just come back to your first question, but about the pre-hedging, I think now even with RFQs, clients got the information to assess what market makers are doing with their information. They can look at what's the prevailing market condition. They could look at the spread quality, where was the fair value, and if they start to see some move while they're doing an RFQ, then after maybe they should be a bit more selective in who they're sharing the RFQ with. Just going back to your previous question about, because I saw that the phrasing was quite interesting, if a client should choose between RFQ or on-exchange. In my view, they should not make this kind of choice. A dealing desk is already quite busy. I think the only question they should ask themselves is whether or not they want to transfer their risk immediately. If they want to transfer the risk immediately, go on RFQ, regardless if it's on exchange and so on. But it's the best way, as long as you've got the right setup with right market makers and so on, no question mark. If you want to work your own order, then I would say that ETF algo is definitely the best approach. Now there is a misconception, I guess, that ETF algo might always trade on exchange. Might be the case on the first version of ETF algo a couple of years ago. But when you look at the newest version, the most complex version, actually they should seek liquidity across multiple pools of liquidity. It can be SI, it can be dark pool, MTF, primary exchange, obviously, but also in some cases RFQs. So the decision about where to trade should not be done at the dealing desk, but more at the algo level, because actually the best outcome if you're blending the liquidity pools and you get an execution traded across several liquidity pools.
You would like to add as well?
Yeah, well, I think
briefly,
I'm 100% in line with what was said. Just maybe one notion. Algos, I think, have one promise, and we are seeing, it's fair to say, emerging algos for ETFs that have to be different to equities. But what I mean by reducing complexity, the ETF liquidity is not just in the lit market or in the RFQ quotes. It's actually hidden in various aspects. It's in the derivative, in the underlying basket, fixed income, equities, etc. So managing all that yourselves when you're interacting with the market is quite a lot. So why actually not trust the algos and say, okay, maybe they can do better. Test it. Even though it's emerging, I'd suggest, well, you should definitely try.
Even if I'm running the risk of like asking something about the algo, which you already have answered, but the general question is, though, that with the algo execution solutions for ETF have gained substantial momentum over the past 2 years. So what specific features make ETF algorithms valuable for investors in terms of cost efficiency, execution quality, and market impact? Frank?
Yeah. I can foresee 4 key features to pick up a good ETF algo. Number one, and that's going to be very specific to ETF, is having this concept of fair value. You need an algo that will be able to benchmark its execution versus the fair value of the ETF. You will never trade at the fair value, but you should trade around the fair value and the depending of the ETF around a certain premium discount band. But by having this concept of fair value, you have a kind of security that your execution, or you're kind of secure about the integrity of your execution. So that's number one. And that's very important because I see a lot of clients actually using cash equity algo for ETF, and that might lead to some bad outcomes. So that's number one. Number two, and I've already alluded that in the previous answer, having an algo that will give you access to several pools of liquidity. You don't want an algo that will just say, I'm going to trade on this order book, full stop. You want an algo that will be able to say, you know what, I can look at dark, midpoint, and so on. I can look actually on some potential cross-listing with different currency, but there might be an axe. You want this kind of algo, really an algo that will be smart enough to source the best liquidity at a given point of time. That's, again, a specificity of ETF, given we've got multiple listings. The third one, I would say, is about well, I guess it's kind of common to any type of algo, having a robust pre- and post-trade setup. You want, as a dealing desk, to anticipate what might be your market impact. And of course, once your execution is done, try to understand what was your potential market impact, what was, your spread capture, and all these kind of things. And finally, the last one, which is again very specific to ETF, is premium discount optimization. ETF naturally, or some ETF, I should say, naturally will trade at a premium discount. You want an algo that will have a feature, smart enough logic to say, okay, right now you're at full premium, so maybe we should slow down. Or right now the premium level is quite good, so maybe let's be a bit more aggressive. So you want this kind of logic in the algo. Last one, but it's not very common, is also having an algo that's going to provide you access to the underlying market. You've got that now on some equity products, for equity ETFs. Hopefully someone will come soon with something on fixed income. That will be a game changer, but basically having the tools that market makers currently have, where you can trade the ETF, but at the same time, if for whatever reason the ETF is going a certain level, you can start to trade either futures market or the underlying market, and then the algo will switch back to an ETF, to the primary market.
Before we dive a little bit more into that detail, also the concept of fair value when it comes to illiquid underlyings, there's one more general question from the audience, which is, a private investor has no access to algos and RFQs. How can they benefit from and access this pricing? Frank? No?
Yeah, indeed, it's an institutional setup at the moment. Yeah, that's for sure. I mean, retail investors, they have very, very good access already to the ETF market, about various venues, and especially also here in Frankfurt, in Germany with Xetra, they have a great offering towards retail. I'm not 100% sure whether that is necessary to have here an algo execution. We're talking usually about institutional business, where you have larger orders which need to be worked, but an instant retail client which want to buy their 100, 200, 1,000 shares, I think there is enough options available already to execute ETFs in a good way.
Robin?
I think we are discussing algos, ETF algos, with one reason: we want to make the markets more efficient. So if markets become more efficient for institutional investors, then automatically retail investors will benefit as well. So I wouldn't worry about the algos not being available to retail investors. I would say, okay, let's make the market more efficient, and then retail will benefit as well.
Yeah. Well, then my follow-up question on the previous topic would be, how is that fair value calculated when the reference market is closed, or when the underlying assets are illiquid or not exchange traded, Frank?
Yeah, that's now really going back to our work we do on a day-to-day basis. No? As I said, Société Générale is a market maker for almost all ETFs here in Europe, and that's our daily work, calculating a fair value of an ETF. Without a fair value, you cannot quote an ETF, because that's the basis of our work. So that's what we do already anyway for almost all ETFs since 20 years. And that is what we now bring into this algo product, which we created together with our colleagues from Bernstein. Unfortunately, Farisa is not here today from Bernstein. But we have, let's say, this know-how of quoting an ETF, creating the fair value, quoting the ETF, knowing exactly what is the price to create and redeem an ETF, and pass this information to the ones which are creating the algos, the algo technology. I mean, Bernstein is already in the market since many, many years on ETF algos, and now they have the technology, and we bring the information from the ETF side now into this space. And quoting ETFs in, let's say, in underlyings which are closed, for instance, now we still quote Japan, we still quote MSCI Japan or whatever at the moment on exchange. So we have already a mechanism in place to do that, and that's our day-to-day work.
So many brokers have developed tailored algo strategies for ETFs. So what type of strategies are you using would be my next question.
That would be usually a question to Farisa, to the Bernstein specialist here, clearly. I know, and it's also what I got from the information from a lot of discussion with trading desks, that the Bernstein algos were always good on the equity side, or they have a technology. And it's also why it took a bit longer on our side, because we started also to implement already algos on the SocGen side. Then there was this joint venture, and many of you know that we made this joint venture with Bernstein, were created, and we said, okay, now we wait till the professionals are in from the algo side, and we bring now both legs together. And their algo is obviously designed to be as flexible as possible, and that's what we try to achieve. On the one hand, we have a lot of products already on this algo, so we are starting really with a big number of equity ETFs in this algo, and Alex mentioned that already. The fixed income stuff would be the next step, and we are doing market making for equities and ETF and fixed income, and we are working close together with our fixed income team in Paris to also provide this information in the future into the algo, and that would be really the next step for this development. Given that Farisa is not here, I think we move on to the question of level of transparency and post-trade analytics. What should investors expect from ETF algo execution providers, Robin?
Well, I think it's two areas. One of them is granularity, that drives transparency, and the second is flexibility. So granularity, stating the obvious, providers should not only provide the outcome on order level, but on fill level when they're executing across different mechanisms, venues. And flexibility means that there is not one size fits all from a post-trade perspective. Alex mentioned trading at the close, so market and close, trading against different benchmarks. So what you have to do is you have to give your clients the choice, arrival price, different flavors maybe of VWAP, the close, market depth. So there are a growing number of options available that need to be provided to investors. That creates trust and will, of course, drive adoption. It's about transparency of what your algos do. And, of course, specific flavors of ETFs like premium discount. You're calculating that, you can provide that to investors as well.
And that's exactly where I see the potential, no? That we have this information, we know where the fair value is, we know what the creation cost and redemption cost is, we know where the premium and discount is at the moment, and that's what we provide into this algo, and can help people then to achieve better result.
Yeah. Alex, would you like to add?
I was just going to add, one of the reasons I can see a lot of clients making a switch also is to become a bit more passive and actually try to capture some of the spread through this passivity. And in terms of pre-trade analysis, they quite like actually assessing how much spread they did capture. And actually, some of the numbers are quite surprising.
Alex, you've been speaking about the advantages of RFQ platforms before, but I would like to bring you back to that point. So why do large institutional investors tend to favor those platforms? Is it just because it's cheaper, or is it having other strategic reasons behind this preference?
You mean for RFQs?
Yes.
Oh, I think it's structural, right? And it's also, I mean, we saw that a big shift in when MiFID II was implemented. It ticks all the boxes for dealing desks, you know, to request in an electronic way best price to market makers, and B, also the platform will manage on their behalf post-trader aspects. So it's in terms of you know, efficiency and so on. There is nothing to add. It's a really good setup. Now, I guess the real question is about how to avoid always having the same approach where you don't need to transfer your risk immediately because there is a cost for that in some cases. And I think until recently, we had a lack of tools in the industry to fit this need. Now we start to have it. We've got 5, 6 ETF algo providers. We should have 2 extra next year. So now I think it can be complement. I don't think it should be RFQ versus algo. I think it should be a mix, a blend.
Yeah. Frank?
It's also, I think, also very important to say it's not one or the other. It's an additional option here, and the trading desks, they have to decide which way to execute. There's a simple example for RFQs, and I had a discussion with a trading desk, the head of a trading desk, and that also, yeah, RFQ. I take RFQ, everything's automated. For me, it's the best way to do that. Otherwise, maybe I have to add headcounts, but I have to reduce headcounts. That's my target. And so it's different in every way, but this algo creates new options.
Robin, I mean, yeah.
Yeah, I think I would clearly avoid a statement like RFQs are bad, and I think we're in line here in the panel. RFQs are not bad. They are very convenient for many years, and they solved a problem. They solved the problem of complexity, as mentioned earlier. So what is it about RFQ, and maybe the pre-hedging question earlier? It's not like RFQs are bad. They're just different. They're different because we have to request a quote, and when we are requesting a quote, even though it's two-sided, we're giving away information, and there are a few participants out there that are very good at guessing or finding out the side of the trade, even though you have a two-sided request. So we should not be surprised that the fair value is adjusted and that there is, through then dynamics between the mechanisms and venues, a price adjustment happening. I think the main challenge from my perspective is that you should be able to measure that. You should not just say, well, this is how it works, just try to measure it. What is the impact? What is actually the impact using that mechanism in comparison to alternative ways? And alternative ways not only that I was used to in the past, but maybe new ways, mentioning algos.
You've also conducted recent studies comparing spread qualities across RFQs and lit venues. What were the key findings, Robin?
So to my earlier point that liquidity is interacting between the order book and of course what market makers quote on RFQs. we try to measure that because we're, as a firm, we're capturing the information from RFQ platforms and the lit markets, all of them. So we were able to measure these dynamics. And the things we've identified is that in some cases, and on average, actually, you have a mid-price move. And what is even more evident is that in the majority of cases, you have a widening of the spread when an RFQ is submitted. So it doesn't mean, again, it doesn't mean that RFQs are bad. It just means that there are liquidity dynamics happening, and you should measure the outcomes of trading ETFs in different ways, not only at time of execution, which is definitely fine from a compliance perspective, but also maybe when you're submitting the RFQ and quantify that.
Yeah, just Alexandre.
No, sorry, I was just going to add, actually, to highlight this complementarity between algo and RFQs. I guess by having a greater adoption around ETF algo, of course, part gonna finish a bit more on screen, lit passively, and so on. But that will also have a positive impact on the RFQ because what Robin just described should be a bit more stable because you will have more end clients participating to the liquidity support. So ETF algo and the growth of lit and so on should also have a positive impact on OTC activity.
So we have 4.5 minutes left for the final question, which is like more or less of a summing up question. So what would be your top recommendation for institutional clients seeking best execution in European ETFs trading today? So who would like to start? You might say the same, I don't know.
Okay, I'm happy to give it a try. Yeah. Maybe one data point that I collected recently during the International Trade Forum in Barcelona a few weeks ago. There was a question to institutional investors about, okay, what is actually holding back further adoption of ETFs? And the number one question was 61% of the attendees thought that it's actually the misperception of liquidity of ETFs. So that is something that we can change as an ecosystem, not immediately, but very quickly. We can change that by using data points. We can change that by generating data points, using new mechanisms, trying them out, measure the outcome, and then change the behavior. And of course, interacting with your trusted partners. So investors speaking to the issuers, because issuers have plenty of these data points available, and that will help us with evolution of the whole market landscape.
Yeah, I will say as a bad word, avoid a one-size-fits-all approach. Now, I really believe that we have a complete toolkit for the desk to really apply different manners to execute an ETF. I will say always question your before trading. What is your targets from an investment standpoint and so on? What's the prevailing market condition? What's the specificities of the ETF? And on the back of that, take an informed decision. And to Robin's point, I think something we didn't have a few years ago was more data points to really assess both pre- and post-trade analysis. Consolidated tape will also come one day. So that's the kind of stuff, where it should bring a greater outcome for end clients and give them more information when they are taking a decision around execution. Yeah,
we cannot give a recommendation, what is good, what is bad. Everyone really has to do it on their own and see what is the best way to execute. I think there are several options on the desk now, new options on the desk, and everybody, that's the duty of every trading is also look into that and getting the best outcome for their clients. And we have another tool now, and that is something to develop and look into, and that is our offering. We as a market maker, we are active on all sides. No? We are active on exchange, we are quoting the products on exchange. We are also active on RFQ, so if clients request the price via RFQ, we are also active there. And we are developing here together with our partners a new tool which offers new options, and that's it. And at the end, the investors has to decide.
Thank you very much, gentlemen. With that, I think we're coming to an end for this panel. Thank you.
Thank you.
Thank you.
Thank you. Sorry.